Welcome to the Top of Mind podcast from Altos Research. This is the show where we talk to real estate industry insiders and experts about the trends shaping the market today. Enjoy the show. Mike Simonsen here. Thanks for joining me today. Welcome to the Top of Mind podcast. If you follow along with Altos Research, you're familiar with our weekly real estate market data video series. With the Top of Mind podcast, we seek to add context to the discussion about what's happening in the market from leaders in the industry. Each week, of course, Altos Research tracks every home in the active real estate market, all the pricing, all the supply and demand, all the inventory and weekly pending home sales, and all the changes in that data. And we make the insights available to you before you see it in the traditional channels. People really need to know what's happening in the housing market right now. So if you need to understand the housing market or communicate about this market to others, go to altosresearch.com, book free consult with our team. Let's review your local market and teach you how to use market data in your business. And I've got a terrific guest today, Sean Dobson. Sean Dobson is the chairman, CEO, and CIO of Amherst, where he's been leading the company for over 20 years, transforming the firm from a regional broker-dealer in mortgage-backed securities into a market-leading real estate investment management and operating platform. Sean has grown Amherst into one of the most important players in the single-family rental business with 50,000 homes in their portfolio. Sean and Amherst were prescient mortgage market players before the GFC and were one of the few survivors because of that insight. As a result, Sean had an active role in educating the White House, Congress, and the Federal Reserve as they navigated the great financial crisis. This conversation today is important because we learn not just about how you run that scale of single-family rental business, but also where it fits into a healthy American housing market. This conversation is data-rich, like all my favorites are. You might have strong opinions about institutional ownership of homes in this country. If so, I encourage you to listen to this episode and learn from Sean, because I sure did. All right, let's get to the show. Sean, welcome to the show.
Well, thank you for having me. It's great to be here.
So let's start. Why don't you introduce our listeners to Amherst and like your journey there? Tell us about the company and you know your whole journey.
Oh, great. Well, thanks for the opportunity. Amherst is a financial services platform. We serve institutional investors globally. Think of our main investment customers are the sort of top 300 to 400 institutions in the world. So these are your global life companies, your sovereign wealth funds, pension and endowment. We deal primarily with what we call the permanent capital base. So these are investors with very long time frames. We focus really, oddly enough, in single family detached investment opportunities. That's been the stock and trade for Amherst since it was founded in 1993. Those first 15 or 20 years, there was a lot of work to do in building liquidity for the mortgage-backed security. And so it's a pool of small investments that got bundled together, and now are the sort of the market that we look at today is very different than when we first started attacking that problem a long time ago. I can't believe it was that long ago.
Yeah, I can't either. And the single-family investment opportunity is vastly different in that time, right? Like in the last 10 or 15 years, really grown up into
it seems like we've had 300 or 400 year floods in the last 35 years.
So what's the business look like now? We like it's single family properties.
Yeah. So the core of the business is a research platform that really built an edge in single family detached real estate, valuation, price forecasting, risk management. And of course, when you think about a single family home as an investor, you can own the mortgage that's secured by the home. And that's what I did for the first 2/3 of my career, was invest in mortgages and all the derivatives of mortgages that obviously it gets very complicated once they become securities. Or you can invest in the equity of the home itself. And if you're going to invest in the equity of the home, of course, you have to figure out how to manage it. So the Amherst trajectory covers really the establishment of the mortgage-backed securities secondary market and complicated securitizations and things, the bifurcating of cash flows out to investors globally so that they could better match assets and liabilities and bring down the cost of capital to homeowners. We got into the credit pricing business because credit the credit risk of mortgages was absorbed by Freddie Mac, Fannie Mae, and FHA for almost ever. And then in the early 2000s, so 2003, 4, 5, 6, the private markets took a lot more of the credit risk. And so we built a specialty on how to analyze and price that risk. And then that sort of helped us pick up the GFC early, because the credit risks were building, and people didn't really appreciate the layers and layers of credit risk that were making their way into the market and scale. And then post-financial crisis, still having that core competency of being able to price these micro assets and think about the risk around these assets, we kind of sat down in 2009, 2010 and said, okay, what's next? And clearly there was opportunity and sort of mayhem at the time, right? The mortgages had fallen in price. Home prices were down 35%. You had 7 million homes in foreclosure. Home prices were printing a new low every day. And so our investors need things that they can invest in scale, and they need long opportunities. So run into them and finding something that's a little bit undervalued, and let's go buy it today and try to sell it, when it appreciates or when it gets back to fair value in 6 or 7 months. It doesn't really help someone managing $1 trillion or $500 billion, right? They need something that they can be thematic. The investment window will open a long time, and the holding periods can be a long time. And the trade-off is they need something that they can really understand the risk attributes of. And of course, it needs to be investable in scale, right? So when we looked around through that lens of what would our customers find interesting, there were some few things. There were people out buying up subprime mortgage originators, thinking that once the machines were turned back on, there would be opportunity investing in subprime mortgages again. We took the position that was a little bit different at the time. It seems obvious now, but at the time we said, well, what's probably not going to happen is investors diving back in to sort of the new version of subprime mortgages, given that so much capital was lost and so much damage was done to the banking system and the global capital markets. And as you know, subprime mortgages became sort of highly regulated and difficult to even originate. So we made the call then that that institutional scale capital would need to be available to invest in the equity of single family detached housing. And so these are $300,000-$400,000 pieces of real estate, and the equity check may only be $80,000 or $100,000. So now imagine trying to fit that investment to that investor base that we've serviced for 35 years when they need to invest and scale for long periods of time. So we said, okay, well, we've kind of seen this movie before, because when I first arrived on the scene in 1987, believe it or not, mortgages were not that liquid. And they weren't that liquid because there wasn't good research, the analytics were a little bit incomplete, and really a small number of banks made a huge impact on creating those secondary markets. And we are proud of the role we got to play in that, in building up analytics, building up really the analytic framework of how to think about interest rate risk and credit risk, and then dealing with complicated capital structures, and then bringing that investment to a global capital market, even though a mortgage at the end of the day is a $300,000 or $400,000 investment. So we said, well, we've kind of seen this movie before over the last 30 years of this kind of backwater product becoming a global liquid product, and serving a large group of consumers. So we said, what if you could build the exact same infrastructure, but for the equity side of the capital structure, not just the debt side of the capital structure? So could you make the equity as investable as we'd help make the debt investable? So that was the mission that we started on in 2010, and here we are 15 years later, believe it or not, and we've made some headway. It's not as liquid as the whatever it is now, $7 trillion MBS market, but there's scale. We've got 50,000 homes that we operate on behalf of our investors. Our peers have another 300,000 homes, I think. But we think that this is a product. The rental home is a product that a lot of people need, and has probably never been more in need given the cost of housing and the cost of capital, the interest rates today. So we're happy that we built it, but it's been kind of an interesting and a long, strange, wonderful trip, as they say, to get such a hand-to-hand combat investment turned into something that has a track record and is scalable.
It's really a fascinating way to look at the single-family rental business as like how do you get institutional capital access to this massive housing market in the U.S. at $35 trillion or $40 trillion market in
It's
the
the
U.S.
giant thing that's tiny,
Yeah.
right? So it's a $50 trillion asset class, but any one investment is $100,000.
$100,000. Yeah. And so there's so much to dive into there. So you ended up since 2010 have acquired 50,000 homes that you operate and as rentals, single family rental homes. And so one of the pioneers in that space, which is, by the way, not universally loved. So we're going to talk about some of that. What are the good sides of that? There have been actual really good sides that I think is worthwhile diving into, and we're going to dive into some of the criticisms of that space too, and see if we can tease it out and what we should know, what I should know, like how to think about that and the impact on housing in general. And so, as I think it's a really powerful story, though, of understanding it is like, mortgage liquidity ultimately translated into better mortgage availability, cheaper prices for the consumer, a better way to buy homes. Like mortgages are more robust and easier to get now because we built in the 90s, really, and 2000s, this liquid environment for mortgages. And so then thinking about that for the asset, for the houses themselves, is a really it's a good way to frame that for our listeners. So that's how we got into the single family rental universe. It was before that time. It was really like a bunch of it was all mom and pop, and still mostly mom and pop.
Yeah. I think we track about 14 million single-family detached homes that are operated as rentals, and I believe we think about 350,000 of those are operated by investors that own more than, say, a few hundred, or even a few dozen, we should say. So that means that the backbone of the single-family rental market has been and probably always will be the small investor operator. Small owner operator, 2 homes, 1 home, 3 homes.
Yeah. Fewer than 4 doors is so talk to me a little bit more about what you've learned about the single family rental business over the last 15 years.
15 years.
You got in the landlord business.
Yeah. Well, yeah. So that's a 4-letter word around here. We don't call ourselves landlords. It's sort of interesting. So Amherst is this large financial services platform that deals in large capital allocations. But we decided that we had to, for safety, for quality of service, for compliance, and for economic efficiency, we decided that we needed to vertically integrate. Eventually, we decided to vertically integrate everything. So under the Amherst platform, you have what we think is the most sophisticated investment management infrastructure to help you do asset allocation, asset selection, risk management, portfolio construction on one end. And on the other end, we have people that are driving around right now in trucks with our property manager's name on the side, a Main Street renewal. And they're servicing our residents in our homes who have an air conditioner that won't work, or a door that's jammed, or an oven that doesn't work, or a leaky roof. That team that's out there in those trucks is an important strategic advantage, and that's how far we had to go in vertical integration to get the operating margins to look like commercial real estate margins, like you would expect in commercial real estate. So we'd hoped that we could outsource a couple of things along the way and not have to own everything down to the trucks. But our customers require 250,000 visits a year to the home. So we're at every home about 5 times a year. And right now, 150,000 of those visits are done by someone who works for the company, so an employee. And we're going to try to make that 200,000 calls in the next 12 months. So almost all those will be handled. And what we hope to do is get to the ones that we don't handle are the ones that require real specialized skills, like it's a big job or it's some sort of complicated HVAC replacement or something. So that's the goal, but that's how far. So they imagine everything in between, from taking phone calls from someone that would like to apply for a home and processing a lease, or putting a home up on Zillow so that someone shopping for a home can find it, or taking photos to get the home marketed. Everything from construction management to brokerage to title to, we have our own insurance company now. We basically write our own our own property insurance, which has been a big strategic advantage. So we went a little bit nutso on vertical integration, but most of it, we think, was we really didn't have a choice. We're investors in our portfolio. We own probably, I forget the number, but I think we own 25% of our portfolio or something is owned by Amherst. And I think that gives us a unique position with our investment partners and our residents, because we don't look at the whole picture. We don't look at portions of the movie, right? We're looking at the whole picture. We're the property manager, but we're also the investment manager, and we're also the investor. So it allows us to think a little bit differently about how to allocate resources.
Great. Well, I have lots to ask you about that and how to allocate resources and what all those things that we're learning about. But a couple other questions on the business first, which is what markets are you guys in?
So we're in about 33 markets. I could list them off for you, but basically, if you drew a picture, I used to tell people it's the Southeast Conference. So if you started in Charlotte and you made your way over to Indianapolis, including St. Louis and Kansas City, and then dropped down and found your way over to Phoenix, that would be the bulk of our portfolio. So we have all the Texas markets, all the Florida markets, all of the North Carolina markets, and kind of everything in between. So we sort of don't go. We have some homes now in Ohio, but it's not a big portfolio. We have a few homes in Seattle and nothing in California.
That's right. Well, and especially buying houses in California. It is a really a very different market than many that you're talking about.
Yeah, it's kind of a laboratory experiment in good regulation, bad regulation, housing affordability, polarity of wealth. I mean, you can see it, right? You can see it, and natural resource issues, right? We all think about California as this lush, beautiful place because when we go to California, we all spend our time within about 30 minutes of the water, right? But when you get to the rest of California, you can see the environment can get pretty tricky pretty quickly.
Yeah, there's a lot we can talk about there, but let's do a quick take on the markets while we're talking about them.
Sure.
We track the every house for sale in the country every week. All the weekly home sales, and as you guys know, with the rental data that we track, all of that stuff that we do. And I think what's really fascinating right now in that data is how your key markets, the Sun Belt, all the way across the country, those are the ones where inventory is significantly higher. Price pressures are significantly weaker. Those are the toughest markets in the country right now, from our data standpoint. Tell me what
toughest for sellers to find a buyer.
Toughest for sellers to find a buyer, for price pressures, maybe year over year home prices ticking down in those markets, where if you're in San Jose, home prices are they're heading up again because inventory is super tight and there's a lot of economic growth. So tell me what you're thinking about market dynamics right now, like buying and pricing dynamics. What's top of mind for you on those?
Yeah. Well, we see the same thing. So we also are monitoring every home that comes for sale, and we have a model price for every home that is for sale, and we monitor the price that it sells compared to our model prices, and we have an estimate for every transaction in the country, when it should sell, what it should sell for. So we're able to and those models are not sort of super complicated. Their regression fits to the history. So what we can do from those models is see when things are starting to move around. So we're seeing the same thing. We've been talking about this for about a year, that we think that the delisting rate was kind of the thing that people should have been paying attention to for the last year. The delisting rate for 2023 was looking at a chart now that sort of got to be 6-7% in the fourth quarter. 24 it got to be almost 9%. And in the first quarter, it's like 7.5%. So those are the two things that we watch the most, Mike, are the denominator is the homes for sale, right? The numerator is the homes that sold.
Yep.
So it's like static pool analysis after a certain period of time, 60, 90 days. So look at a static group of homes, watch them over 30, 60, 90 days. see what the velocity was for sale, what percentage of them sold in those time frames, and it'll start to tell you what's going on with the market. The second statistic that's super important there is take the denominator is the homes listed for sale, the numerators are the people that gave up and pulled the home off the market. And that give up rate or that delisting rate has been rising. It rose all year in 2023 and 2024, been rising for a while. So just by watching the stuff that's for sale, it can be a little bit. It's like the duck on the pond. You can't really see what's going on underneath the surface. You don't see is the inventory rising or declining because of, is it rising or is it declining because homes are selling, or is it declining because people are giving up? So those mean two different things. So look, the housing market, we're in this for the next, our customers are in this market for the next 50 years, right? So what's going to happen in the next 4 or 5 months, I don't know. It's clearly trading heavy. The market is clearly trading heavy in Florida. It's clearly been trading heavy in Dallas and not so much in Houston or San Antonio. Those markets are starting to the Texas markets, I think, have chopped through the backlog. And it's starting to get very, very sub-market specific. But look, since 2019, nationally, home prices are up 40-something%.
Yeah.
Just simple reversion to the mean will tell you that a little breather might not be a bad thing.
Not be a bad thing. So then, terrific. I love those stats, and I think we'll express them in those terms. Like those are really great. And we work with your data team on those, so it's like it's cool to see which ones you find are really compelling. I'll spend some time with the velocity and the delist rate. Do the markets that are slowing down now, or feeling slower, the ones where the delist rates are higher, does that feel like buy opportunity, or does that feel like, oh, I need to wait? Like, how do you how do you play those kinds of changes?
Like I said, we're such long-term holders and and investors that entry point matters a little bit, right? But if we buy a home 10% cheaper 2 years from now, we're treading water, right? Because the additional return on the home is lost someplace else. So it's not so much a market timing thing. I would just say that if I was going to allocate $100 to the sector, I might allocate, $10 this year and $20 2 years from now, kind of thing, right? Is that the market is more likely to be soft than it is to be strong in terms of entry points. The rental market has been fascinating because there was just a tremendous supply of homes came up for rent in 2022 and 2023, and it really dampened rent growth as all that inventory hit the market. We went back and parsed sort of where it came from, and it came from a bunch of different places. A lot of the build to rent stuff hit the market kind of at the same window, and then a lot of homes that were sort of tied up during COVID, where we had those long periods of time where defaults were allowed to run for a year or 2 years, and sort of those finally worked themselves through the system in 2022, and all that inventory went back on the market. And then in Florida, you had a hurricane that took a bunch of supply off the market, and then it was restored at the market at the same time. So you sort of had these three factors of like the recovery from the natural disasters, the long default cycles, and then this builder's supply all kind of hit at the same time. So what we're seeing is that the for sale market is fading. There's way less competition from buyers. We're seeing the people giving up and moving their homes off the market, which tells us that there's pressure on price. And at the same time, we're seeing the rental growth sort of restoring. So from an investor's perspective, and I think, Mike, this is kind of how we see this happening, and this is what we'd hoped for. This was the original proposal we made to the government when we asked them to stop selling homes, is that the housing market is a single cylinder engine. Either consumers can buy them or they can't. They can buy them or they can't. They can buy, and that creates volatility for everyone, and not good volatility, right? And when the Federal Reserve lowers interest rates, even though incomes are rising, that engine starts firing high and too high, right? Whenever the consumer gets in trouble, like they did in 2000, like done a few times in my career, 2001, 2008 for sure, the engine locks up, right? So what we proposed is a two-cylinder engine to say, okay, if the conditions are great for the consumers to own the home, great, right? And that's what happens today, right? The home ownership rate's been rising the whole time that institutional SFR has been a thing, right? But in those moments of time to where that is not working, right? That single cylinder isn't working. Then investor capital, if there's a capacity to actually evaluate, invest in, and manage the assets, then investor capital can be that counterbalance to the housing market. And I think that's what you'll see going forward is far less volatility, because home prices, from an investment perspective, home prices are pretty compelling now. And if they were to become even lower priced, it'd be even more compelling. So I think that some of the volatility is coming out of the housing market because now investors can actually react. When we went around in 2010 and home prices were down, whatever they were, 35% nationally, 65% in Arizona, people were like, great, I'd love to invest in distressed housing, but how, right? I go buy 10,000 houses, well, then what, right? Who's got to pay the water bill and the power bill, and how do I collect rent? And so we didn't have that then. And so I think now that you have it, now that's an interesting, and we'll talk a bit about the narrative, but like having that capacity available in the market is really an economic sort of shock absorber that everyone needs to make sure stays in place.
That's an excellent analogy. I really appreciate that. And so your take is that really, as a function of the last 15 years or so, we are probably less volatile in home price swings due to the presence of investors, like institutional scale investors.
Right.
Less likely to have a price crash.
That's right. At some point, the yield on invested dollars will become attractive enough that the investors will step in and prevent you from having these air pockets that developed in the housing market when there was really only one user. And there were two users before, right? Something like a third of all housing has been investor owned forever. But in the single family detached market, which dwarfs the multifamily market, predominantly you had one use case for it from a scale capital perspective.
Right.
You could get, mortgages were available in volume, but equity wasn't available in volume. And that's what's changed.
And that's what's changed. That's really fascinating. And so, I could say that in 22, going into 23, I remember looking at like Phoenix and saying, okay, prices are down year over year in Phoenix. They're ticking down. And what I didn't know at the beginning of 23 was, do declining home prices in Phoenix, an investor-heavy market, do investors run away and exacerbate the downturn, or do they step in with their cash and put a floor on prices? And it turned out they put a floor on prices in Phoenix in 2023, which is, I think, your point. Like when things got attractive like that, helped homeowners not have.
That band should stay relatively tight, right? Where the homeowner has an advantage, where the investor has an advantage, or where the economics work out for the investor, for the homeowner, they're going to stay relatively tight, and you shouldn't get these 65% drops in Phoenix again.
Yeah. That's really terrific. That's the pro side of the argument on the single family rental business. Let's talk about some of the criticisms real quick, just to go through them. And so, we could start with the broad thing about the broad criticism, which is like housing should be about shelter, not an investment. And although your point is that a third of housing has always been an investment property,
thankfully.
And then the other question is like, was the presence of massive global investor capital in the last 15 years, did that exacerbate the upside pro-cyclically on the run up? And what should we think about those in general, and some of the criticisms of the single family rental?
Yeah. Well, I think that as a nation, ownership should be the priority, not rentership. Right? That should be the priority. And we have sort of one of the most amazing housing markets in the world. I get to travel all over the world, and what people are really jealous of is the 30-year fixed rate, fully prepayable, non-recourse mortgage, right? And that's what I spent my career creating liquidity for. And it's a pretty cool tool. I tell people the American dream isn't home ownership. The American dream is to issue a 30-year fixed rate mortgage, right? Because so long as there's inflation, your monthly payment, not only is it fixed, you're paying it with inflated dollars. So it's an incredible tool, and it doesn't necessarily get you stuck in a home, right? You can cash it in and go get another one. So, and by the way, when your home appreciates, you can go refinance it and get a larger mortgage if you want to, and take equity out of the transaction and reset some of your risk. So that is a uniquely American product. You can't get 30-year fixed rate mortgages, as far as I know, anywhere else in the world except for these United States, which is pretty fascinating. And it's a complicated thing, by the way, to manage, right? So we think we kind of figured it out, but it's very complicated because as an investor, you could have an investment that lasts for 6 months or 30 years. Right? So how do you, and by the way, it's some tiny investment. So it's a uniquely American invention. And I think it has created a tremendous amount of wealth for American consumers. And we're super proud of the role that we played in that. No nation on the earth has a homeownership rate of 100%. So the homeownership is not desirable for some portion of the population at a given point in time. They're moving somewhere and they're not committed to the location. It's not possible sometimes because their financial situation doesn't allow them to qualify for that golden 30-year fixed rate mortgage. And that family's got to have some place to live. So what kind of gets lost in some of this fun rhetoric of institutional investors competing with consumers or driving up home prices or whatever. And most grown-ups understand that that's all sort of bumper sticker stuff. It's not real economics. But it hurts when people are out there sort of throwing eggs at your business, and it hurts our employees who get up every day and don't think they're doing a bad thing, right? But what gets lost is who we serve. And Mike, who we serve are people, and we watch this very closely. 85% of our customers have a credit score and liquidity profile that makes them ineligible for a mortgage in the year 2025. Not ineligible for one at a price of X, ineligible for one at any price. So whenever a house comes up for sale, the way I like to say it is, whenever a house comes up for sale, there's about 6 or 7 families that would like to move into that home. The nation is that underbuilt. We still get 20 or 25 tours of every home we put up for rent. Okay? So that home comes up for sale. There's 6 or 7 families that would like to live there. And one, maybe 2 of those families has a high credit score, has a low debt burden between their student loans and their credit cards and things, and has accumulated the required amount of cash to buy the home, which could be in the starter home market, it's still 30, 40, 50,000 after-tax dollars that you have to bring to the closing table. So maybe there's one, maybe there's 2, maybe 2 of those 6 or 7 families can show up with a pre-approved Freddie Mac, Fannie Mae 30-year mortgage, which is fantastic, right? The others can't. They want to live there, and they want to put their kids in school there, and they want to have the benefits of suburban lifestyle in America in terms of access to schools and the services that young families need. But they're not going to qualify for a mortgage in 2025. That's who we serve.
That's an excellent interpretation of the business, and I think will be very helpful for a lot of folks who have I like to say that the concept of Wall Street landlord is like the ready-made villain, like the easiest thing to
What I tell them is that unfortunately, whether they don't like me or not, I've been at the closing table with them for 35 years.
That's right. Right? And so
I just happen to be writing the mortgage before. And in this case, and think about the market penetration. So since Amherst has been buying homes in the last 15 years, the rough numbers is there's been something like half of the U.S. housing market has turned over. So that means that there's been a little over 40 million sales. We got 50,000 of them. The rest of the large investors got 300,000 of them. So we bought 350,000 out of something like 40 million, right? So all of this rhetoric of we affected the price or what have you is really from not serious people who don't really understand economics. Yeah. And so we spend time with them and we try to figure out like what's upsetting them. But when they really drill down and say, okay, it's not the choice isn't the family that rents the home today was prevented from being the homeowner because of Sean. Like that's what people that's their instinct, right? Is that family could have bought the home. And when they sort of get out of the headlines and look at the details and they see, oh, wait a minute, that family is primarily single parents who have kids that they want to put in great schools. That family has a lot of student debt that didn't manifest in an education that was worth what they paid for it. That family got in trouble through lack of financial education, which the state should take responsibility for in terms of getting credit cards too soon and getting other forms of consumer credit too soon. And they've driven their FICO score down. And then, oh, by the way, we passed a law called Dodd-Frank that made it illegal to risk-based price mortgages. And oh, by the way, 98% of mortgages are granted by some federal agency. And oh, by the way, my family is not included in that. They can't get a mortgage. So when you really look at the facts of like, who am I serving, you'll see that their alternative wasn't to buy the home. Their alternative was to live in an apartment complex or a far worse home in a far worse neighborhood.
There is I think, the big misconception is that Wall Street is buying everything. And I think as you're very clear here pointing out is like, it's actually a really tiny percentage of homes, but there's a valid customer set for them. And so I appreciate that very much. You mentioned a couple things as you're talking, Dodd-Frank and literally and really the ability to qualify for a mortgage. I'm interested in your take on the affordability crisis in the country.
Yeah.
What do you think about it? How did we get here? Is it going away? Are there solutions? And you have a broad take on affordability.
Well, I mean, we get asked all the time to come in and write the white paper for some state or federal government agency on how to fix the housing crisis. And if we had the solution, we would definitely put it up on our website. How we got here is super complicated, but the unfortunate fact is that they're all houses are affordable to someone. If they weren't affordable, they wouldn't be selling, right? And I think what we're more concerned about is the polarity of who are they affordable for versus who are they not affordable to, and we should be upset about it, because if you look over time, I have this beautiful chart that we built a while ago that basically says what percentage of the U.S. Consumer base does the mortgage market serve, and prior to Freddie Mac and Fannie Mae's creation, the mortgage market served the top 20 or 30% of consumers and when I say top, I mean from a wealth and income perspective, right? The top earners. So they could get a mortgage and the others couldn't. When Freddie Mac and Fannie Mae came along, that coverage became amazing. It became more like 2/3, right, of families could qualify for a mortgage. They might have to put a little more down payment. They may have to buy mortgage insurance, but they could get on the ownership ladder somehow. Post-financial crisis, we're back to almost where we were before Freddie Mac and Fannie Mae were created. We only serve wealthy. Our mortgage market only serves wealthy borrowers. And we have a very high required credit score. We have a very high required down payment. We make mortgage insurance unaffordable. And we have overcorrected for the financial crisis for a very long time. And it's prevented home ownership for millions and millions of families who could have succeeded. What I'd like to point out is even in the dumbest pool of mortgages made with the most ridiculous standards, even the dumbest pool, about 2/3 of the loans worked. So, which means if you just put the money in a barrel and put it on the corner and had people sign up for how much they took to buy the home, 2/3 of the people would get a home and get to buy a home, and the lender would do just fine, right? We've struggled with 2/3 success rate because we focus on the 1/3 that didn't succeed, and we're not prepared for that in our banking system or in our court system. So there's how we got to the affordability problem is probably the largest, sort of single factor is constraining credit. And Mike, we've put this stat out there a few times in the last month. Since 2019, this problem has become not just, a significant sort of fairness issue. It's become intractable. So if you run the numbers, we don't look at house prices as a whole number, right? No, very rarely do people come in with a wheelbarrow and pay $400,000 for a home, right? We look at home prices as total monthly cost, principal, interest, taxes, insurance, and maintenance, PITIM, right? That number since 2019 has gone up 80%. Your monthly payment required to buy the exact same home, not a different home, not a different mix of homes, but take any home you want and figure out in 2019, when no one loved affordability metrics in 2019, by the way, right? It wasn't like 2019 was the greatest time ever to buy a home, right? From there, principal, interest, taxes, and maintenance have risen by 80%. Incomes are up about 17. So we already took a fairness issue, let's call it a Gini coefficient issue or a polarity of wealth issue, and we just have now stretched it to something that's ridiculous. And there's never been a larger need for investors to come in and fill that gap, because one of the things that I've started to even annoy myself by saying so much is that there's all these ideas of shared ownership and shared appreciation mortgages, and somehow we're going to make impact fees less and blah, 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 blah. But we're not talking about like an affordability gap where people just need like an extra couple $100 a month. We're talking about a third or 40% of the cost is unaffordable. So what we tell them is like, there's lots of ideas and we should experiment with all of them and find the one that works. But in the meantime, school starts tomorrow. And so these ideas are going to cook for years. School starts tomorrow. And so when they throw sand in my gears and they try to prevent the formation of capital or sort of try to regulate away my ability to invest in the market, what they're really saying is that they don't want my residents in their neighborhood. That's what they're really saying. And we're not going to stand for that. Our residents have just as high of right to live in those neighborhoods as anyone else does. And they just happen to need us to provide more of the capital than the other people. The other guys needed us to provide the mortgage capital. These guys happen to need us to provide it all. Either way, we're going to get them into that neighborhood.
Yeah, and so do you have views on? You called it intractable, like it's we've gotten to an intractable spot with affordability. Do you have views on any way out?
Time. So really, there's three inputs to the equation, right? There's the consumer's income, right? There is the cost of the capital, right? And there's the cost of the home. And you put those in any order, but that's the three inputs that go into the formula to see if the home is going to sell. To what percentage is the home available for sale, right? And so, like I said, they'll sell to someone, but right now they're selling to the top, most wealthy Americans, and they're not selling to the next deserving group of customers. So we don't see, and maybe we're just blind to it, but we don't see that big catalyst that's going to cause the price to go down dramatically, because you're still dealing with the shortage. What you're seeing, by the way, in the stuff that's coming available for sale isn't representative of the stock of housing. It's a little bit adversely selected, and particularly from a location perspective. So the real weakness in housing is in the exurbs, and there's a reason for that. So we think it's really going to take time, because you're going to need to improve all three. You need American incomes to continue to rise, and you need interest rates to normalize. Interest rates are probably about 1 to 1.5% higher than they should be, given all other economic factors at the table.
You think that's mortgage rates or the 10-year?
Mortgage rates. Yeah, mortgage rates never really recovered with interest rates. So the thing that people haven't really followed, I think, as close as they should have, is that the mortgage market lost its sponsors. Something like a third of all mortgages used to be owned by Freddie Mac, Fannie Mae, and the investment banks. And they all became basically barred from owning them in any reasonable scale. So mortgages never got back to as efficient as they were in terms of just a price, like the rate itself. And then, of course, the access, the window or the box of who can get one became sort of super narrow. So I think you're going to need interest rates to normalize, you're going to need incomes to rise, and you need home prices to just moderate in terms of their growth rate, so that they don't grow faster than the buying power of the consumers. And I don't really have the magic wand to speed this up. So you could have a decade where you have moderate home price growth while incomes restore and while interest rates stabilize. And I know there's so much going on in federal policy now, with tariffs and with taxation, and if you're a public company, you have to put out multiple scenarios for your return, for your earnings for the next 6 months. So it's hard to say how this is going to happen. But I think to the extent that you see policies that create higher earning capacity for Americans in a service economy, and you see interest rates coming down and normalizing, and you see softness in home prices, you start to see that affordability problem being chipped away at. But we think it's going to be chipped away at. It's not going to be taken off in one big move.
Yeah, and we are actually in a multi-year of home prices, not that, like, actually kind of normalizing. The asset prices kind of normalizing.
Our investors, this investment is so boring, right? Like, we're like, a home is supposed to be sort of a 8% return, right? It's not 18, it's not 20, it's not 30, right? It's 8%, right? And so if you're a large investor, 8% in US dollars, that has this exposure to inflation, so that as wages go up, the cost to build the home goes up, replacement cost goes up, the affordability goes up, right? So you're kind of inflation protected, 8%. It's a pretty good deal. But that 8% is expecting like 3 or 4% changes in price per annum, not 40% in what really was 5 years.
5 years. Yeah. So we may get a decade of flat prices.
I would say normal. We would think of the normalized prices,
Normalized.
sort of like inflation plus something, not a multiple of inflation like we saw. And then like what we saw happen, by the way, is the exact thing that happened in 2003 when you had personal incomes rising and interest rates collapsing. That creates the conditions for people to run home prices way up.
Yeah. Do you have so as you pointed out, it's a little murky right now looking at the macro outlook for the year and for 2025, 26. Do you have some guidelines that you're thinking about, like what your expectations are, rates and housing market and things like that you're...
Luckily I get to invest in 10, 20-year cycles. So trying to anticipate the next tweet and the impact from the next tweet, I don't have to do. But look, I think that look, the economic policies that are coming out of the White House, they're not crazy. They may seem crazy, but they're not crazy, right? So like we have to get where American wage growth has to stay persistently high. It has to, right? So our workers have to get paid more. They just have to. And if we keep creating these sort of trade deals where it's just cheaper to export, to build things overseas and import them constantly, it's going to be difficult for us to create U.S. wage growth the way we need to. So I think that there's this how you do it. Obviously, it can be opined upon, but I think that we have to make the American worker more competitive, and we have to figure out job opportunities for a spectrum of American workers that hasn't really been focused on. And you're looking at like the push-pull for the American economy has been we've needed wage inflation for a long time. All the capital investment goes into technology, which is designed to bring down the need for human intervention, right? So you have this huge push-pull where productivity increases offset wage growth. And now with generative AI and the hundreds of billions of dollars in investment in generative AI, you have to wonder, is there a chance you get wage deflation at really in the white collar space because of the technology may be good enough to replace those high paying jobs. So I would say that I'd rather invest in the U.S. than anywhere else, and I'd rather be long inflation than short inflation, and I'd like to see policies that make our workforce more competitive globally.
Yeah. Okay. We won't spend time diving into the details, so the implementation of some of those details. But we'll assume that there's some noble goals underlying some of that, some of the implementation. So okay. So and then I guess the bigger question I have on market outlook stuff, and whether that's in your 10-year horizon, but like in the current macro environment, is Amherst's strategy shifting at all? 2010s versus the 2020s.
Yeah, we've definitely gotten into the build for sale business, which I never thought we'd be in. So we're fully vertically integrated on the development side too. We talked about the operating side. We're fully vertically integrated in the real estate development side too. So we can buy land and get it permitted and put in streets and plumbing and then we have this really cool big experiment going on in using offsite construction that we're excited about.
Oh, neat.
So so all of that real estate development capability has been focused not only on the for rent market but also the for sale market, right? So that we're able to take advantage of that two piston engine. So that's been a pretty big strategy shift, and part of that became driven by the fact that for the last 3 years the for sale market has just been so much healthier than the for rent market.
Got it. So you're on the construction side as well.
We're full-blown real estate development. So we have a factory the really cool story. We bought a 100-year-old factory in a town called Cuero in South Texas, and it was a textile plant that had been closed and all the equipment sold overseas, and those textiles were manufactured somewhere in Southeast Asia now, and the factory sat dormant for a couple of dozen years, I think. So we bought it It was a pretty cool story. It was like a haunted house, but it's this huge factory. And we turned it into a modular home factory. We call it a studio. It's a home built in a studio. So that gives us the ability to do, maybe 80% of the construction of a home off-site. And the cool thing is it's the same home you would build on site. It's 2x4 sheetrock, a permanent foundation, ceiling joists, blah, blah, blah. Same HVAC, same whatever. But I'm able to have on-staff talent to do the framing, the flooring, the electricians work for us, the plumbers work for us. Instead of having this parade, what I call the parade of trades, that comes in and kind of builds a neighborhood, we have American workers in a factory setting, learning really to become craftsmen in construction instead of sort of the alternatives. So we're pretty proud of that, and the product, it builds a better product. It's a lot of wood to chop on this one though, because the consumer, rightfully so, it's not their fault, but they think that a modular home, well, first of all, modular, mobile, trailer house, trailer park, we got all that to deal with. And so these are not movable structures. These are, what we like to say is that a mobile home is a type of home, a modular home is a method of construction. So there's a lot of misnomers in there. So we have to overcome that with the consumers and the cities, by the way. So we go into a city to tell them we're going to build modular homes. Oftentimes they say, no, we don't want mobile homes. So we got to go through all this. There's a big education piece there. And then there's also a belief that it should be less expensive because you built it in a factory.
That's my next question. It's not less expensive. Got it. Okay.
No, it's not less expensive when you look at the narrow window of 2x4s and sheetrock and Romex and pipe. It's not. It's a way better product because I got the quality controls of a factory. I mean, imagine if you bought a BMW and they said, okay, we're going to sell you this BMW for, in our case, a $350,000 BMW, and we're going to build it over there in that field, and we're going to drag all the parts out there in the field and put your BMW together. You'd be like, whoa, 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 whoa. Hold on. And so that's how homes are built. So building them in the factory, you get a better product. But there's a lot of education to be experienced. And there's a lot of investment to get that education delivered out there. But we think that the reason we built it wasn't to go build neighborhoods. The reason we built it is Mike, because the nation's home building capacity, and you're seeing it now, the weakness you see in housing, when you go plot it out geographically, you're going to see it's in the exurbs. Like the homes that aren't trading are in the exurbs. And a lot of it is because it's competing with a lot of new build supply. And there's no good science, by the way, on how many homes to build in a market, right? You kind of build them until they stop selling. And usually you keep building them and they stop selling and now you have them and you got to fix the price. So the big opportunity we think is to revitalize the urban core and those first ring suburbs throughout the Southeast. And unfortunately for the United States right now, the building technology we have doesn't lend itself to building one home at one location at one time. The technology we have is to order 6 foundations, 6 frames, 6 roofs, right? 6 HVACs. And they come through and they build them all with this parade of trades. If you tell them, okay, guys, over there on that street, 6 blocks in from downtown, I want you to build me one house. So I need one foundation and one frame and one plumbing joist and one, forget it, right? Like the cost is double the market value of the home. So our cost is the same as building that home in the neighborhood. Our cost to build the one is the same as the cost to build the whole neighborhood on a per unit basis. So we don't have a price deficiency when we go to just do one. So our goal is to take down a lot of really toxic housing that sits inside of our urban core. It's full of lead-based paint, it's full of asbestos, it's full of aluminum wiring and iron pipes, and it's also not very land efficient. A lot of those homes are built on really big lots and really small homes. And it's really not what people want anymore. They're low ceilings and tight floor plans. So our goal is to be able to very efficiently drop in, take out the house that's 100 years old, and drop in maybe 2 or 3 of our homes that were built primarily off-site and finish them up and do that efficiently so that we can take out rental stock and replace rental stock. It's kind of the anti-gentrification trade, right? So we can put, right now the only way for that home to come down is for the land value to appreciate so much that the rental stock comes out and for sale stock replaces it. And that's what small investors have been doing in these kind of gentrifying neighborhoods. So we think that we're not there yet. The way we do biz dev around here is that we put our own money at work while we're learning. The first 100 homes that scattered site homes we bought for SFR platform was all bought with partners' money, and it was I mean, it was anything but what we thought it was going to be. But after 100 homes, we kind of figured it out, and that's where we are with our modular plan. We're about 300 homes into it now, and now they're coming off the factory floors on time, on budget, and they're going all the way through permitting and C of O on time and on budget. And we think there's just an enormous amount of value to be created to go take down, densify, and improve the housing all between the first loop and downtown in Charlotte, Dallas, Houston, Jacksonville, Atlanta, like all over the country, because those homes were all built in the 40s and 50s, and they got to go.
And they got to go. That is terrific. That's a really neat shift in strategy. One that I think not enough folks have thought about, and
there may be a reason. I'll let you know.
Yeah.
It's
Well,
been an adventure.
We have reached a point where the factory construction opportunity is really compelling.
Yeah, I mean it's interesting as the supply chain gets tighter, as the labor pool gets tighter, the building in a factory setting could actually be more competitive. But right now we compete with a lot of loosey-goosey application of labor laws. So the house that we build in a neighborhood, we have on-staff employees with full benefits and going to work in a factory every day that has OSHA risk controls or whatever. And we're competing with someone who builds a home, where they drag all the parts out in the field and have somebody put them together. So it's not really the same product, and it's not the same cost structure.
That's really, really terrific. Well, Sean, we're coming up to the top of the hour already. I could keep going for a long time. This is a great conversation. I'd like to ask my guests about vision for the future. Like, do you have a vision? You have a 10, 20-year horizon on your investments. Talk to me about how you think about the housing economy. What happens over the next decade that I should pay attention to?
Well, I think that some of this is unpopular, but we should probably get on the table. But I think that historically, like, there is this, as I said before, let me try to get my foot in my mouth here, right? Is ownership should be the goal, okay? But the sacred cow of ownership probably needs to go away. And the things we have to think about is when ownership became the American dream, and we did all the things we could to create 30-year mortgages and as a nation, think of the things that Americans could invest in at the time, right? So when all you could invest in was a home, the only thing you could get leverage on was a home. The only thing you as a middle-class investor could really invest in was a home. People invested in homes, right? And the home has taken an outsized place in their portfolio, their asset allocation. So one of the thought experiments that I think is interesting to ask people to do is imagine if your brother or sister came to you and they said, "Hey, my financial advisor has come to me and they found this incredible opportunity, and what they want me to do is take 100% of my cash and leverage it 4-to-1 and invest it on one street corner in one town." We'd say call the SEC against that financial advisor, because that's ridiculous, right? And yet that's what the American dream is, right? Is to take a highly concentrated bet in one location on this home. So now, living in that home and the benefits of living in that home may not always need to be coupled with owning that home or having so much financial exposure in that home. So I think that as we get further along in fractionalization of assets, and as we get further along in the development of our capital, of our infrastructure, I think it might make more sense for people to own less than 100% of the home they live in, because it doesn't really make any financial sense. And right now, in the past, we just thought about, well, home ownership is good because I think like an owner, I invest in my community, I act like an owner, I get the inflation benefits of being long an asset, a real estate, and short debt. And so as long as the government keeps spending more money than it's taking in, there's going to be inflation, so I get protection from that. So there's a whole bunch of reasons, societal benefits and economic benefits for someone to own their home. But I think we're going to have to disentangle those a little bit and say, let's get those societal benefits of the ownership mentality for the community, but maybe not necessarily have this greatly overexposed position. Because that young couple that comes in, think about that, a financial advisor comes in and says, okay, you two newlyweds came in, you're 32 years old, you're going to be working another 30 years, so let's put all your assets let's put all your investments into an asset that's going to earn 8%. well, that family should be investing in things that are way more riskier because of the horizon they have. So I think that over the next decade, hopefully we'll get some grown-up conversations and get away from sort of the bumper sticker conversation of like where home ownership lies in America and what that means to people and what it should mean, and get a little bit away from theology and a little bit back into math about how the nation's capital should be invested.
That's a really fascinating view. It is a sacred cow. It'd be really fascinating to see if we could shake the consumer's perspective of that. Like,
well, I think the consumer is doing it already. So you can pick up your phone and you can buy a Bitcoin, you can buy a share of stock, you can do a bunch of things. And by the way, like you can have the benefits of the home and have the benefits of investing in the stock market, because you can rent the home. So as a nation, we should think about optimal capital allocation, and for the endowment that's investing over 30 years, an 8% return is great. For that 32-year-old couple, an 8% return with the 4% volatility, maybe not so good. So over time, we got to sort of elevate the conversation, because this becomes a drag nationally on our national return on investment.
Yeah, for sure. That's a really fascinating approach. I appreciate, Sean. We've hit an hour already. It's really great. Your views on and the work you've done with Amherst has been really compelling. Love working with you guys. You publish Amherst publishes a bunch of stuff on your website, right? Like you do some research and things like that.
We've reduced the frequency of publications. We do. We like to, if we're building a research piece that sort of has broad appeal, we'll publish it there. A lot of the stuff we do is very narrowly focused and a lot of wonky stuff that people won't care about. And really, over the last year, it's been about understanding where single-family detached housing fits into a global portfolio. Like, what is the risk return? What are its returns correlated to? What other investments is it similar to, and how are those investments priced? And I think most people, unless you're selling a podcast that allows people to go to sleep at night, they they probably wouldn't find that too interesting. But if you're a big global, if you're managing $2 trillion with a 50-year horizon, that's the kind of stuff that people lean on Amherst for.
Yeah, for sure. Sean Dobson, the company is Amherst. It's been a real pleasure talking to you. I'm glad we got a chance to do this face-to-face. And everybody, this is the Top of Mind podcast. Thanks for listening. And if you enjoyed the show and want to hear more people like Sean, I appreciate a review, the 5-star review, wherever you get your podcast, so that other people can find the show. Thanks, everybody. We'll be back soon.